Ladies and gentlemen, good day and welcome to the Q4 FY26 earnings conference call for Manaksia Coated Metals and Industries Limited, hosted by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Sana Kapoor from Go India Advisors. Thank you, and over to you, ma'am.
Thanks, Robin. Good afternoon, everyone, and welcome to Manaksia Coated Metals and Industries Limited earnings call to discuss Q4 and FY26 financial performance. Today, we are joined by Mr. Karan Agrawal, Full-Time Director, Mr. Mahendra Bang, Chief Financial Officer, and Mr. Tushar Agrawal, Senior Vice President. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risks that the company faces. May I now request Mr. Karan Agrawal to take us through the company's business outlook and financial highlights, subsequent to which we will open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Sana. Good afternoon, everyone. A very warm welcome to the Q4 and FY26 earnings call of Manaksia Coated Metals and Industries Limited. I am Karan Agrawal, Full-Time Director of the company, and I'm delighted to host you today, our valued analysts, investors, and stakeholders who have taken the time to join us. Today, we will walk you through our financial and operational performance for the quarter ended 31st March 2026, as well as for the full financial year FY26. Following my opening remarks, we will open the floor for a Q&A session. Our financial results and highlights are available on our website, www.manaksiacoatedmetals.com, as well as on the stock exchange portals. Before we dive into the numbers, I want to take a moment to set the context for the year that was FY26. It was in many respects a year defined by two parallel stories, one of remarkable strategic progress and financial strength, and one of unprecedented external disruptions that tested our operational resilience. The macro environment, particularly the escalating conflict in the Middle East, created significant headwinds across global supply chains, logistics, energy markets, and commodity costs. Freight rates surged by nearly 100% quarter-on-quarter. Industrial fuels such as propane and LPG witnessed an unprecedented shortage, with prices spiking by almost 200% within a fortnight. Key raw materials and consumables, many of which are petrochemical byproducts, saw cost escalations in the range of 50 to 75%. Metal prices, including aluminum and zinc, climbed to 5-year highs. Supply of critical inputs was severely disrupted, delaying the execution of high-value export orders. These are not excuses. They are the reality of global operating environment that every participant in our industry had to navigate. And I am pleased to say that our company navigated these headwinds with discipline, agility, and a clear strategic focus. Our full year's numbers bear the testimony to that. Let me begin with the headline. Financial year 2026 has been our strongest year on record across virtually every financial and operating metric. Revenue for the full year on a consolidated basis grew by 13.5% year-on-year, crossing rupees 896 crore. This marks a significant milestone as we move towards the rupees 1,000 crore revenue landmark. Price realization per ton improved meaningfully to rupees 82,193 per ton in FY26 compared to rupees 73,622 per ton in FY25, reflecting our deliberate shift towards higher value-added products and better product mix. Our EBITDA for the full year stood at rupees 92.21 crore, a strong increase of 49.21% year-on-year. EBITDA margin for the year expanded by 246 basis points to 10.29%, reflecting our improved operational efficiency and product premiumization. EBITDA per ton touched rupees 8,838 per ton, growing 43.54% year-on-year, a clear measure of value we are adding per unit of production. At the bottom line, our profit after tax for FY26 grew by an exceptional 164% year-on-year, touching rupees 40.69 crore. PAT margin expanded by 259 basis points to 4.54% for the full year. Our earnings per share registered an increase of 211% year-on-year, touching rupees 4.32 per share for FY26. Equally significant is the improvement in our balance sheet strength. Our interest coverage ratio touched 2.85x compared to 1.63x in FY25. The current ratio reached an all-time high of 1.75x, improving from 1.35x. Our debt equity ratio improved substantially to 1.13 times from a level of 1.81 in FY25. Most importantly, we achieved our targeted net debt to EBITDA ratio of 1.01x in FY26, a remarkable improvement from 1.93x in FY25. This demonstrates that we are not just growing profitably, we are growing with financial discipline and balance sheet rigor. I am pleased to share that our external credit rating was upgraded in FY26. Long-term rating was upgraded to A from A-, and short-term rating was upgraded to A1 from A2. This upgrade is a recognition by independent credit rating agencies of our strengthened financial position and improved debt management practices. Turning to our quarterly performance, Q4 of FY26 was a quarter of strong sequential recovery, even as the Middle East crisis created headwinds that temporarily weighed on margins. This quarter's performance reflects the stabilization phase following the successful commissioning of the Aluzen technology upgrade. While steady production and quality have been achieved, the capacity utilization is being ramped up in a phased and incremental manner. Revenue for Q4 FY26 stood at rupees 228.74 crore, registering a robust 20.45% growth quarter-on-quarter and a 9% growth year-on-year. EBITDA for Q4 FY26 stood at rupees 15.64 crore with an EBITDA margin of 6.84%. The year-on-year softness in Q4 margin was entirely attributable to the extraordinary cost escalation in energy and raw materials triggered by the Middle East conflict, which compressed margins in the quarter. We want to be transparent. This was a one-time shock that materially elevated our input costs, and it is not reflective of the underlying earnings power of the business. The important fact that should be shared with you is that we are successfully able to pass through the entire impact of the incremental costs to our customers, and we have strong visibility of EBITDA earnings for the quarters yet to unfold. PAT for Q4 FY26 was rupees 5.37 crore, registering a growth of 6.73% year-on-year with a PAT margin of 2.35%. I would now like to invite Mr. Tushar Agrawal, Senior Vice President in the company, to share insights about operational highlights for the full year of FY26, along with important updates on projects and investments in pipeline and future outlook. Thank you very much. Over to you, Tushar.
Good afternoon, everyone. From an operational standpoint, FY26 has been a year of meaningful progress across all dimensions. Production of galvanized and aluminum coated steel reached 103,036 metric tons for the full year, registering a growth of 2.21% year-on-year. Production of pre-painted steel grew by an impressive 12.78% year-on-year to 83,594 metric tons for FY26. Perhaps the most important operational shift in FY26 is the sharp increase in value-added product mix. Pre-painted steel, our highest value product, now constitutes 80% of total quantity sold in FY26, up from 74% in FY25. This is a deliberate and consistent strategy of premiumization, and we are pleased with this trajectory. On the exports front, FY26 was a watershed year. Export tonnage touched an all-time high of 66,172 metric tons, growing 110% year-on-year compared to 31,453 metric tons in FY25. The share of exports as a percentage of total revenue grew 68.21% to the share of exports as a percentage of total revenue grew to 68.21% in FY26 from 39.21% in FY25. A growth of 97% year-on-year. This demonstrates both our global market acceptance and the competitiveness of our product quality. I'd like to take you through some of our strategic projects. In FY26, the year has been of significant strategic investments that will shape our growth trajectory for the years ahead. Let me briefly update you on each. The first is the aluzinc coating technology upgrade. Our most transformative project of the year, the aluminum zinc coating line, was commissioned at the end of December 25. MCMIL has emerged as one of the few producers in India with 100% aluminum zinc coating capacity. This upgrade increases our capacity from 132,000 metric ton to 180,000 metric ton. A 36% increase, and positions us as a premium coated steel segment offering superior corrosion resistance, enhanced surface finish, and longer product life. Customer acceptance has been excellent. All long-term customers have appreciated the quality and pledged strong orders for H1 FY27. Importantly, we are able to pass through 100% of the incremental cost to these customers and are seeing strong EBITDA per metric ton visibility on all new aluzinc sales. The second color coating line, which is the phase 2 expansion, we've placed an order with Mass Roll Pro Limited for our second color coating line, which is in advanced stages of erection and commissioning, with a targeted completion date of July 26. This line will add 150,000 metric tons of color coating capacity, taking our total capacity from 86,000 tons to 236,000 tons, a 174% increase. This will significantly expand our ability to serve a larger and more diverse customer base and drive higher contribution margins. The 7 megawatt solar power plant. In line with our commitment to green energy and ESG principles, we have issued a purchase order to Prozeal Green Energy for a 7 megawatt captive solar power project in Gujarat. This project is also targeted for commissioning by July 26. The project will offset 50 to 55% of grid power dependency, significantly reducing our per unit power cost and lowering our carbon footprint. all of which contribute to long-term competitiveness and sustainability. On our technology and customer management front, we have finalized Salesforce as our preferred CRM platform. This will give us 360-degree customer visibility, strengthen our sales pipeline management, improve demand forecasting, and build stronger data-backed customer relationships as we scale our business. The outlook for H1 FY27 and beyond. Looking ahead, we enter FY27 with strong operational momentum, improved financial health, and significant capacity additions coming on stream. The ramp-up of our Alusink line, the upcoming commissioning of our second color coating line, and the solar power plant are all expected to meaningfully contribute to revenue, margins, and profitability from H1 FY27 onwards. Customer feedback on our new Alusink and pre-painted Alusink products has been very encouraging. Order visibility for H1 FY27 is strong from both domestic and export markets. We expect the demand environment to remain robust, and with the normalization of energy and raw material costs, assuming no further escalation in global conflicts, our margin recovery in H1 27 should be meaningful. We remain committed to our stated strategy of premiumization, export growth, capacity expansion, and balance sheet deleveraging. Every action we have taken in FY26, from Alusink upgrade to credit rating improvement to reduction in net debt to EBITDA, is in service of building a stronger, more resilient, and more profitable MCMIL. In closing, I want to express my sincere gratitude to our board of directors for their guidance and governance, our employees and teams at every level of their hard work and commitment, our customers for their trust in MCMIL's products and partnerships, and our investors and analysts for your continued confidence and support. FY26 was a year we can be proud of, not just for the numbers, but for what they represent. A company executing on its strategy, strengthening its fundamentals, and investing in its future. Even in the face of significant global adversity, we look forward to sharing even stronger results in the quarters ahead. With that, let me hand over to the moderator to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. Once again, that's star and 1 to ask a question. Our first question comes from the line of Jairam Birawat from Yes Securities. Please go ahead.
Hello. Firstly, congratulations for a great set of numbers and really liked your detailed presentation. Couple of questions from my end. Firstly, can you please help me with what is the total capex outlay planned till FY28 and how will it be funded?
Hi, good afternoon, Mr. Jairam. Thank you for your question. Well, I think the project-wise capital outlay that we have for the current projects in pipeline are for the second color coating line, which is going to commission in Q2 of FY27, is roughly about 65 crore rupees. And the solar captive power plant, which is also going to commission in the Q2 of FY27, the capital outlay is rupees 30 crore. And both these projects have been funded by a healthy mix of debt and equity, where the proceeds from the last fundraise have been used for the contribution of equity and, debt has been taken from PSU banks in India.
Okay. Uh, The company is aggressively expanding capacity 2 to 3x in across segments. So what gives the confidence that demand will keep pace, especially in export markets, where the 80% of the order book is concentrated?
So I think what gives us confidence is that we have achieved 80% export rate while climbing from lows of 20%-25%, which was 3 years, 4 years back. So every year we have been seeing an incremental growth in our order book, in our export numbers, in our Q-on-Q performance, where we have reached from a level of 20%-25% export revenue to today, a level where we are touching 70% export revenue. And this has been a very, consistent curve of growth. It has not been erratic, it has not been seasonal, it has not been one time. And this gives us the confidence that the way we are trying to penetrate the market and build long-term relations with OEMs in the overseas markets, with long-term MOUs, obviously with we are satisfying their commercial and quality needs and service needs, is giving us the confidence that we can maintain growth of the export business. The rate of growth will definitely not be the same, where from FY25 to FY26, we have doubled our exports. We have grown at 100% year-on-year. The growth rate will definitely slow down because it's not practical to expect 100% growth each year. But I can assure you that we are quite confident of growth in the units of the revenue that export contributes, as well as the tonnage of exports that we are achieving.
Uh, Okay. And, with the shift from galvanized to alu-zinc, what is the
Yeah.
sustainable EBITDA upside? And is it driven by pricing power or cost efficiency?
I think the sustainable level of EBITDA that Alu-Zinc can contribute to our business on a long-term basis would definitely be superior to what we have been earning while selling galvanized, while producing and selling galvanized and pre-painted galvanized. Now, the question is how much of a premium? Now, that can be answered by many aspects that are few are within our control and few are not in our control. The ones that are in our control is our costs, is our efficiencies, is our yield, is our capacity utilization, and the ones that are not in our control are external factors like geopolitical environment, demand, competition, etc. So I think it will be wrong for me to give, a round figure or a number to you. I can only tell you that the product per se, which is alu-zinc and pre-painted alu-zinc, is definitely a product that is a more profitable product, both in terms of costs and price realization. The extent of premium achieved, or EBITDA per ton margin achieved, is a whole, contribution of many factors, internal and external.
Okay, okay. And last question from my end, what is the progress on setting up the CRM complex, and will the capacity make you 100% captive for HRC?
Okay. So we do have ambitions to do backward integration and set up a cold rolling complex, which basically reduces our dependability on the current raw material, which is cold rolled steel. Um, It will definitely open our access to many, many more flexible options of buying raw material from domestic and international sources, and it will improve the efficiency of our, inventory management and raw material flexibility. Now, we have not yet fixed any date to this project. We do want to do this within FY28. That is our, that is the blueprint that we have decided upon. We are yet to work on the nitty-gritties of financial tie-up, supplier selection, and all the other, needs of the project. So this, I can say that we definitely have the ambition to do it and to do it within FY28. And I think as soon as we complete the projects on hand, which is the second color coating line, the solar power plant, this would be the next on our list to embark upon.
Okay. Okay. Thank you so much for your detailed answer. Thank you. All the best.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and one. That is star and one to ask a question. Our next question comes from the line of Jatin Damania from Swan Investments. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. So just wanted to understand your breakup in terms of your CapEx that we are doing. So once we complete our entire CapEx by FY28, what sorts of potential revenue one can expect from the facility that we'll be having at the peak utilization?
Good afternoon, Jatinji. Thank you for your question. So if we are talking about FY28, I'm assuming that you are asking after the anticipated projects of cold rolling mill and the second alu zinc line.
Right.
Am I right?
Right.
Yes. So if these projects are actually started and completed within FY28, we will have installed capacity of 360,000 ton for cold rolling, followed by 360,000 ton of alu zinc, followed by 236,000 tons of pre-painted alu zinc.
Right.
So we have to assume a certain capacity utilization. It cannot be at 100% capacity utilization. So assuming that a 360,000 ton unit is producing, is having a capacity utilization of roughly about, let's say, 80-85%, which is normal in our industry, which means production and sale of between 3 to 3.2 lakh ton, which has the potential to generate a revenue of anywhere in the range of 2,500 to 2,700 crore per annum.
Okay.
Yes.
And so when you indicated now, probably we will be starting our focusing on green power, and our 7 megawatt of facility is likely to come in FY27. So what sort of incremental benefit one can estimate from the power savings for the full year?
The captive solar power plant of 7 megawatt that we are investing in will give us access to renewable power, which will replace roughly about 50 to 55% of our energy dependency on the grid. In terms of monetary savings, it has the potential to basically generate savings of between 7 to 7.5 crore rupees per annum, just in terms of power cost.
So that will be start reflecting from Q2 of financial year 27, right?
The project is currently in a phase where we are expecting it to get commissioned within Q2. Now, it all depends which period of Q2 it actually starts giving the contribution, whether it's the first month, second month, or third month of Q2. That is yet to be, really, I cannot tell you the exact day and date, but at least partial impact will be felt in Q2, and full impact will be felt in Q3 for sure. Q3 onwards for sure.
Means entire 7 crore, full 7 crore benefits shall get reflected in FY28, and probably in FY27 we'll see a part benefit of that.
Yes, we can see half of the benefit in FY27. Yes.
And with the completion of all the project and the revenue of 2,500 crore that you indicated, what sorts of ROC you guys are what sort of ROC one should assume on the company level? And if you can break up your IRR or ROC breakup for the CRL and the new coating line, that will be great. Great.
See, Jatinji, the ROCE that you are asking for FY28 is based on a lot of assumptions and projections, which are all hypothetical. So I can only tell you that we are aspiring to do projects and invest in projects that are having high ROCE rates, which are, definitely above 20%. I mean, for me to tell you what will be the ROCE of the project is, very difficult at this point of time, because we have still not put in the money for the project, right? These are all Excel sheet workings at the moment, and based on projections and numbers that are hypothetical. Therefore, I can tell you that any project that the company invests in will definitely be under an assumed targeted ROCE of upwards of 20%.
Okay. Noted. Okay. Thank you, sir. That's all from my side.
Thank you. Thank you, sir.
Thank you. Participants who wish to ask questions may press star and one. You may press star and one to ask a question. Our next question comes from the line of Dipesh Sancheti with Manya Finance. Please go ahead.
Hi, am I audible?
Yes, yes.
Yeah. Do you expect this elevated cost environment, the raw material, to persist for Q1 and FY27 as well as for the going quarters ahead? If yes, then can you quantify the likely impact on margins and EBITDA per ton?
Yeah, good question, Dipeshji. See, as we stand today, it is already the second month of the quarter that you are asking the question for. And the situation with the geopolitical environment and the conflict is known to all. The cost of crude oil, the situation of the rupee against the dollar is again known to all. And the costs of all petroleum byproducts, metals like aluminum and zinc remain at an elevated level. Therefore, I can tell you that the cost structure of inputs, of raw materials, of consumables, etc., as we speak today, remain consistent at a high level, which we have experienced since the start of the conflict. However, the good part is that in the last month or so, let's say since the beginning of April, all the new orders and the new contracts that the company has been entering into with long-term customers, both domestic and international, we have been able to pass through the entire impact of the incremental costs, whether it's on the energy side, raw material side, consumable side, freight side, everything to the customers in the new pricing and the new costing that we're doing. So the impact on the margins will not be negative. Rather, I would say that we have kept a good buffer in our costings and in our calculations because the situation is so dynamic and unpredictable that we feel that our margin situation should be drastically better than what we experienced in Q4 of FY26.
Right. And with net debt to equity at 1.12, how much leverage increase is expected during the CapEx cycle? And do you have any threshold as to how much debt to equity ratio you want to maintain, or you want to go at max?
Well, as of now, due to the equity fundraise that we did last year, as well as the earnings that the company has enjoyed in FY26, we have been able to take impact of both these infusions and earnings into our debt equity ratio for a favorable outcome, and we have achieved 1.13 times. I feel that even in the situation of having CapEx incoming in the upcoming quarters and the upcoming years, we definitely want to be conservative on the leverage front. And I cannot tell you what will the ratio be going forward, but I can definitely tell you that the company does not have any plans to go aggressive for leverage, and we will definitely not breach a level of 2x. I mean, that is also extremely high in my view, but we will definitely not breach a level of 2x, and will strive to actually be anywhere in the range of between 1 to 1.5x.
Okay. Just want to understand, how quickly are you able to pass on the cost pressures as well as any cost benefits? Now, let's say if the crude comes down and things, become normal as they were,
Yeah.
how fast will the cost reductions will take place? And, what will be will that affect our EBITDA margins in the positive way, since there will be a lag in passing on the cost?
Absolutely. I think, you have rightly said that just like how we faced a shock when the conflict began, where we had to absorb a shock of increased costs in Q4 after the war started, in late February. In the same manner, in case we have to assume a situation where all the costs of energy, freights, everything starts plummeting and going down, we will definitely have a window of opportunity where we will be experiencing a lower cost environment in terms of our production and shipments, but we will be enjoying prices that we have concluded beforehand, which are of the higher cost kind of costing structure. But I think overall, these are very short-lived periods and windows. These are not consistent. We cannot enjoy arbitrage period beyond a month, because that is not sustainable, number one, and number two, it is not fair for the seller or the buyer. So I think these kind of impacts in our business are short-lived. I would say anywhere between 1 month to 2 months is the maximum period where one would need to absorb any shock or enjoy the benefits of a lower cost environment. It would become equilibrium post that.
So max 1 quarter it will get affected. That is what is it safe to assume?
I think that would be pretty much a good way to summarize it, yes.
Yeah. And what is the company having any particular target of ROE? Because we maintained at around 14%, which is decent. But if you see the historic ROE has been always lower. So are we able to will we be able to maintain this ROE going forward also?
So I think when we did raise external capital last year, and we did all these investments in the aluzinc technology upgrade, the second color coating line, the solar power plant, et cetera, these were all basically to elevate the ROEs and ROCEs, which were at a lower kind of a level, which we were not happy with. And I think now that the fundraise is actually being put to use and the revenue generation has started from the start of this calendar year, or let's say, the true realization or the incremental impact on ROE and ROCE will be felt in FY27, when all these investments are going to start churning revenue and giving contributions to the EBITDA earnings. And as far as the percentage is concerned, you are seeing it at 14% today. I think with the contributions of the upcoming projects of the second color coating line, of the solar power plant, and the better capacity utilization of the aluzinc line, I think, in my view, things should rather improve further.
Okay. And we don't have any further fundraising plans as of now, right? Since we are not doing any CapEx.
The CapEx that we intend to do after these projects that are getting commissioned in Q2 of FY27, like I said before to one of the participants, is that the backward integration project of the cold rolling mill would be the next project that we would like to embark upon. However, it is too early to comment whether we will be, wanting to raise any fund from the market or not for this project.
Right. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and one. That is star and one to join the question queue. Our next question comes from the line of Yash Purbe with Inved Research. Please go ahead. Sir, you are not clearly audible. Your volume is very low. If you could please change the mode on your device.
Hello, is it audible right now?
Yes, this is much better. So please go ahead.
Thank you for this opportunity. So I just wanted to ask, like, overall vision, like we have a vision to grow 3x of the capacity. So what is the roadmap to achieve that, and what are the key drivers?
Sorry to interrupt, Yash, but your line is very bad in clarity.
Hello.
Yes, go ahead.
Yeah. So I just wanted to ask, like, what is the roadmap to achieve the vision of FY29 of 3x growth, and what are the key drivers behind that?
The vision. Thank you for your question, Yash. The vision for our growth up to FY29, having the ambition to become 3x in revenue and profitability, are mainly driven by our ambitions to increase capacity to 0.36 million ton, and having backward integration of cold rolling as well as horizontal capacity expansion in the alu-zinc production capacity. So I think if we are able to successfully achieve all these ambitions, we will achieve our vision of having a 3x P&L and balance sheet by FY29.
And sir, what do you think could be the key challenges in achieving this?
Key challenges in achieving this vision, well, I mean, again, this would be a very theoretical answer, but anything to do with government policies, external geopolitical conditions, GDP of the country, demand of the country, public sector and private sector projects in the country all of these would define how much investment is being done for the growth of the country in critical projects, in infrastructure building, and our ability to fund the projects on time and at lower cost. I think all of these factors would be quite crucial to determine the success of these investments.
Okay. And sir, my last question would be, what would be the sustainable EBITDA margin for the medium term, and what could be the peak EBITDA margins we can expect going forward? All your projects are live.
At the moment, for FY26, we have achieved an EBITDA margin of double digits. We have crossed 10% in terms of our EBITDA margins. And for the foreseeable future, with the new product, with the upgraded technology, with the ramp-up of exports, we feel that an EBITDA margin of anywhere between 10 to 12% is possible and sustainable.
Okay. Thank you, sir. Those were my questions.
Thank you.
Thank you. Participants who wish to ask questions, you may press star and one on your touchtone telephones. That is star and one to ask a question, ladies and gentlemen. Our next question comes from the line of Jay Mehta with Navkar Capital. Please go ahead.
Hello. Thank you for the opportunity. I just wanted to congratulate on a great set of numbers despite, recent macro changes in the global scenario. Sir, I wanted to ask about the alu-zinc line. I just want to understand whether any new export market is opening up for us since we are opening this value-added product. Thank you.
Thank you for your question, Mehta ji. I think, yeah, it's a very relevant question, and this is something that we are working on every day. There are several markets in the world that have a preference for an alu-zinc product over a conventional galvanized product. I can tell you that in the Americas, which is North America, South America, Central America, Caribbean, all this entire region is having a very good dominance and preference of alu-zinc product as their preferred choice of product for roofing, construction, building material, rather than conventional galvanized steel. We are working towards developing such markets. One of them, like I said, is the Americas region, North and South and Central. Of course, in our existing markets of Europe, Africa, Middle East also, with the introduction of alu-zinc, we are able to approach, more quality conscious customers who want a higher value-added product, better quality, higher consistency, a better life, better performance. We are able to make inroads to these customers and, gradually increase our foothold and market share in such customers who are used to buying alu-zinc product rather than conventional galvanized product. Definitely it is helping us in growing our, footprint in the export markets.
Sir, since you mentioned the U.S. market, from the U.S. market, you will get higher revenue per ton for your products. Can you, in the percentage term, would you be able to tell how much extra it would be compared to your existing markets?
I think what I tried to tell you is the regions of the world which have a preference or a dominance for alu-zinc. Our intention is not to immediately approach the U.S. market for our exports. Currently, we do not have any exposure to the U.S. market. I think it has been a blessing for us that we did not have any exposure to U.S. markets because of whatever happened after the Trump administration took over. Right now, in the Americas region, the markets that could be our likely destinations that we want to work on would be South America, Central America region. It would definitely command a slight premium over our existing markets that we're exporting to because of the nature of alu-zinc and because that particular region already is offering such kind of price levels.
That's great, sir. Thank you so much, and all the best.
My pleasure. Thank you.
Thank you. Participants, you may press star and one to ask a question. That is star and one to ask a question. Our next question is from the line of Disha from Sapphire. Please go ahead.
Hello.
You are audible, ma'am. You may
Audible,
proceed.
sir? Yes.
Yes,
Thank you
sure.
so much for this thank you so much for this opportunity. So firstly, on this pre-painted steel capacity, this additional 150,000 metric tons that will be coming online by Q2, what will be the peak revenue from this at optimal utilization?
Thank you for your question. So the new color coating line, which is coming of 150,000 ton capacity, we feel that over and above the existing revenue that we are already generating with the installed capacities, assuming that it would take some time to stabilize the line and achieve a decent capacity utilization, we feel that in FY27 we can anticipate anywhere between let's say anywhere between 300 to 500 crore, in that range, of incremental revenue from the new capacity being installed. It's a big range between 300 to 500 crore. That is because it's difficult for me to predict the rate of increase in capacity utilization. It will be a gradual phenomenon.
Right.
And we will definitely aim to do our best.
Right. And this, the new alu-zinc line that we have currently, 180,000 that is installed, we can expect to reach 80-85 sort of utilization in FY27. Will that be a fair assumption?
Absolutely. Definitely within FY27. I cannot tell you at what point in FY27 because we are still in very early stages of the new line getting commissioned. It has just been 3 months. So I think, usually such large and complex lines take, a fair share of time to stabilize and for the production team, the operations team, the quality team to get the confidence of ramping up the line speed, the production rate, et cetera. So I think you can, it's safe to assume that the second half of the year would definitely see a much higher rate of capacity utilization as compared to the first half of the year.
Right. And you mentioned this 3 lakh. You mentioned this 3 lakh 60,000. The total capacity will have a peak revenue of around 2,500 to 2,700 CR, right?
Yes, hypothetically, yes.
Yeah. So if we take, say, 1,100, 1,200 from Zinc, you mentioned 300, 500. So anywhere, can we look at 300 to 600 sort of revenues for FY27?
I'm sorry, you were not very clear in the second part of your question.
Yeah. So I mentioned, so around 1,100 to 1,200 CR from Zinc and 300 to 500 from this new color coating line. So can we do revenues of around 1,500 to 1,600 CR for FY27? Would that be a fair assessment?
Look, like I said, that the new color coating line would be the only capacity that would give us the incremental revenue in FY27, along with the higher capacity utilization of the Zinc line. Now, these two aspects combined, I have already answered your question that one can expect an incremental revenue of anywhere between 300 to 500 crores over what we have done in FY26. I think you can do the math and potentially come to a conclusion on that, yeah?
All right. Okay. Okay, that's very clear. Okay, thank you so much, sir. That's it from my side.
Thank you very much.
Thank you. Participants, you may press star and 1 to ask a question. We have our next question from the line of Rushang Shah with Pramesh Wealth Private Limited. Please go ahead. Rushang Shah, your line has been unmuted. You may proceed with your question. As there is no response from the current participant, we will proceed to the next question, which will be from the line of Samira Midda, an individual investor. Please go ahead.
Hello. Good afternoon, sir. Am I audible?
You are audible, ma'am. You may proceed.
Sir, I have few questions. First one is, since for past 2-3 months, we have been seeing this global tensions and increased freight costs and everything. So are our existing customers refraining from placing new orders, or the pipeline is still robust?
Thank you for your question. Despite the tensions and the uncertain environment in the global markets, we are quite proud to be in a situation where we have a long-term confidence of our customers, our long-term customers. And we do enjoy a situation where our current order book is in the range of between 350 to 400 crores. And this is all largely from export customers. So I think it would be wrong to assume that our customers are not inclined to place orders in the current situation. Rather, I would say that in order to build buffer and to, tide over the uncertainty that the current situation has created, our long-term customers are rather being cautious and ordering more in advance or potentially a little bit of a higher quantity to ensure that their bare minimum requirements are met in time and met adequately. So I think that, yes, there are benefits and upsides and downsides to this situation. We have already seen the downside with the elevated costs and the, freights and energy situation. But now we are seeing some of the benefits where we are able to enjoy a good order pipeline and at a healthy price realization.
Okay, sir. That was helpful. And sir, another question is, how much premium does this new product Alu Zinc enjoy as compared to the previous galvanized steel?
The premium of Alu-Zinc over galvanized steel is basically dependent on multiple factors, such as the demand situation in the market, such as the specification of the product that you're talking about, whether it's a thinner gauge product, a thicker gauge product, the grammage of the coating versus the grammage of the coating in galvanized. But I think to broadly answer your question as a layman, I would say it's fair to assume that a premium of between 3 to 5,000 rupees a ton is ballpark that one can say is a fair premium over galvanized steel.
So this figure that you are mentioning, it is the price realization, right?
Correct.
Okay.
The premium and the price realization.
Okay. And sir, my another question is, I remember that in your previous calls, you mentioned that our existing customers also use this new product. So what do you think, will our entire capacity would be used to cater our existing customers, or we will have to find new customers?
I think, ma'am, finding new customers and new markets is a constant exercise that we keep doing. It does not stop at any point of time. I think there has not been a single quarter in the last 4 or 5 years where we would have not added a new customer. So I think then the fattest share of the business and the revenues comes from regular and long-term customers, which would be upwards of 70%. But in the balance, 25%-30% revenue, there is a churn of new customers being added and some customers not giving business. So that is, I think, the nature of business. And what we are happy about is that the lion's share of revenue is coming from repeat customers and long-term customers.
No, sir, actually, I was asking regarding, since we have transitioned to this new product. So that is why I was asking that our entire capacity, will that be used to serve the existing customers, or because it is a new product now?
I understand your question. I think on that front, I can tell you that most of our domestic and export customers that we had while we were producing galvanized and pre-painted galvanized steel, most of them were already having some exposure, some small, some large, to Alu-Zinc. Now, we are fortunate that we were able to transition to Alu-Zinc very smoothly, and as on date, we are already using upwards of 60%, 65% capacity utilization on the new Alu-Zinc line, and most of it is going to existing customers. So the need to add new customers would be only proportionate to the increase in capacity utilization that we are going to do in future, for which, yes, we will definitely need to add new customers to sell that extra amount of tonnage that we are going to produce. And I do not see any challenge in achieving that kind of new customer growth or penetration in the export markets and domestic market. There is enough opportunity and market to cater to.
All right, sir. Thank you for the insightful answers, and wish you all the best.
My pleasure. Thank you.
Thank you. We have no further questions, ladies and gentlemen. I would now like to hand the conference over to the management for closing comments. Over to you.
Thank you very much to the analysts, to the investors and stakeholders who have joined the call and given their precious time to hear us out. I want to express my sincere gratitude to the board of directors, to our employees, and the teams that are working very hard and giving all their commitment and energy to achieve organizational goals. I want to thank our customers for their trust in our products. And I want to thank our investors and analysts for the continued confidence and support. We look forward to interacting with all of you regularly and also to welcome you in our next earnings call very soon. Thank you very much.
Thank you. On behalf of Go India Advisors, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.